Welcome to Biz 417's Paycheck Protection Program PPP Forgiveness Webinar, presented by BKD CPAs Advisors. I'm Logan Aguirre. I'm the president and associate publisher at Biz 417. You probably joined us 8 weeks ago when we teamed up with BKD to break down the PPP program within the CARES Act and what all that program entailed. From there, many of us applied for and were granted the loan. And then on May 15th, the SBA and U.S. Treasury released the forgiveness application with instructions on how to complete the form. But there's still a lot of questions, right? It was kind of a daunting form that they sent out. And today we're going to walk through how to apply for forgiveness, explain the required supporting documentation, and answer questions that our experts have been receiving. So today with us, we have Corey Stone, a manager at BKD CPAs Advisors, and Nathan Fitzgerald, a senior manager at BKD CPAs Advisors. Corey and Nathan, give us a little bit of information and background about what you know and your experience so far with the PPP program.
Sure. So,
yeah,
as you mentioned, go ahead, Corey.
Go ahead. So we were here 8 weeks ago, and a lot has changed since then. We've gotten a lot more guidance from SBA, from the Treasury, a lot of talk out of Congress, specifically around the PPP. It's still not finalized. I wish we could say we have all the rules and we know all the answers at this point, but last night the word was the House and Senate got together in bipartisan support and they are trying to extend the 8 weeks to 20 weeks. There's a bill in the House that extends it to 24 weeks. The bill in the Senate extends it to 16 weeks. The word now is that we're going to have 20 weeks to spend the money. So it's constantly evolving. We're constantly getting more guidance and things from SBA and Treasury, but I'll let Nathan kind of piggyback on that.
Yeah, so as you mentioned, the SBA's come out with our loan forgiveness application, which was very much appreciated. I think it provided a little bit of clarity for a lot of the companies, the businesses, the individuals who have made these loan applications with exactly kind of the structure, the form of forgiveness. But as Corey mentioned, things are continuing to evolve. So subsequent to the loan forgiveness application being issued, we were on May the 22nd, so last Friday, we received 2 additional interim final rules from the SBA, and we have an expectation that things are going to continue to evolve. We're going to, I think, be in receipt of some additional FAQs from the SBA, as well as additional interim final rules, which are really going to lay out the framework here behind the PPP forgiveness, specifically how the forgiveness is going to be computed and work. So that puts business owners at certainly at a disadvantage right now, where they're flying a little bit blind. I think everybody's motivated to try to qualify for the maximum amount of loan forgiveness. And as the rules are ever changing and evolving, that is certainly going to impact the business's ability to make a business decision that would ideally set them up for increased forgiveness. To Corey's point, if we see an extension of the definition of the covered period, so that's going to be an extension of the amount of time that a business is going to have to utilize the funds that they receive through the PPP program. That's really going to fundamentally change the economics of the forgiveness. And if that were extended to 20 weeks, some of the things that we anticipate talking through today are really going to be more or less a moot point. So
thank you, guys. Yeah, it's an evolving and, like you said, ever-changing process, and everyone's trying to just get their heads around what we know so far. So we're glad we have you guys with us today. So Corey and Nathan have clients that they've been working with around the clock on this, and we're going to address the most common questions that they've been getting, sort of try to give the biggest overview we can. And then if we have questions, a lot of you submitted questions and we read those over as we were preparing today. So we will be trying to touch on those as we walk through our questions that we're going to ask. And at the end, if we have time, we'll try to get to some others. But we have a lot of content to get to, and thank you for those that submitted in advance, because we're hoping we can get to those. Some, if they are very, very specific to your specific business, I don't know that we'll get to those today. We would just encourage that you probably talk to your own accountant on those things that are hyper specific to your business. But we're gonna just jump in and do our best to cover as much content as we can today. So the first thing, you guys have talked about how the rules are changing and that's ever evolving, and that the application period or the window with which we have to use the funds might stretch. But because we do have the application now, how long do people have to fill it out, and when is it due, and what all is needed for that? Let's start there.
So presently, the loan forgiveness application shows an expiration date of October the 31st. We know that we're going to kind of be, I guess, we're going to have to allow for enough time here to get through the June 30th timeframe, because that some of our employee numbers as of June 30th, as well as the salaries that we're providing to those employees as of June 30th, are going to impact our forgiveness computation. So we know that we're going to have at least through that June 30th timeframe to actually still accumulate data, accumulate information that's going to be incorporated into the application. From a deadline perspective, the lender or financial institution has 60 days from the date that they receive the loan forgiveness application to render a decision on approval of the amount of forgiveness that's granted. But for the applicant, presently there's not a specific deadline given that says, you know, within 5 days, 15 days, 20 days after the end of the covered period that you have to submit your application. As Corey mentioned, you know, if we see an extension of the covered period here, either through a bipartisan bill that's agreed to by both the Senate and the House, if we see an extension of this covered period, we anticipate that that's going to further extend the amount of time that a business is going to have to provide their loan forgiveness application back to their financial institution. And really, you know, as things are continuing to evolve and as we're kind of accelerating through some of the initial applicants' covered periods, we fully expect that financial institutions are going to wait until at the earliest the middle of July before they even begin to accept those applications, because I don't think that they're going to want to be in a position where they have accepted an application, there's further or additional clarification that's made that ends up fundamentally changing the computation of the loan forgiveness amount, and that has to be reworked and they have to pull it from the queue. So I think we're going to see that that's going to, you know, set us up to say that financial institutions, I think, are going to start accepting those probably in the middle of July if things stay as they presently are. But if we see an extension of covered period, that's going to be deferred out even further. And I think we're also seeing that the financial institutions are going to be want to position themselves to begin accepting those as quickly as possible so that they can start working through those forgiveness applications. There's going to be a tremendous volume of work that's going to have to be done on the financial institution side, and they're going to want to start to be in receipt of those as quick as possible. But I do think it's going to be sometime out there in the middle to late July before they even begin accepting the loan forgiveness application.
So Can you guys talk a little bit about how, the funds were to be used within an 8-week period, and how that 8-week period was determined, what the beginning of it and end of it is? So we have a lot of questions regarding payroll
Yeah, so we
within that time
talk.
period.
Yeah, we can talk through date ranges. So at the beginning of the program, your covered period, your 8-week period, started on the day that you got your money. When they issued the forgiveness application and the IFRs, they gave us an alternate covered period. So if you got funded in the middle of a pay period, you can choose the alternate covered period, and you can start your covered period on the next start date of a payroll. So if you go, if you're a weekly or bi-weekly payroll, you can choose this election. If you're monthly or semi-monthly, you don't have this option, and you're going to be prorated within your 8-week covered period that starts on the day you got your loan. But if you, let's say you got funded on a Wednesday and your payroll ends on Sunday and restarted that next Monday, you could kick it out to Monday. If you're bi-weekly and you were a week and a half away, you could potentially kick it a week and a half down the road to start your 8-week period. Now, if they change it to 20 weeks, that opens up a whole new issue with the weeks, but we could still kick it out. You've got 20 weeks to spend the money that you got for payroll. You're probably going to spend most of it on payroll anyways. So, but to answer the question, you can either start it on the day you got your money, or you can start it on the first day of your next pay period.
And when you say start it, that's part of the application. On your application, what date you put?
Correct. You would make that election on the loan forgiveness application.
Okay. So can you guys talk about the compensation cap over the cover period?
Yeah, sure. So, and this is, I think, been an ongoing question that a lot of people have, and it really, at the, I think, baseline level, one of the big questions is what about bonuses? What about hazard pay? And that's something that I think we're planning on covering here today as well. But we know that there is a compensation cap. It is based upon $100,000 annual salary, prorated for your covered period or your 8-week period, which mathematically comes down to say that the maximum amount of compensation that's going to qualify for forgiveness is going to be $15,385. And another question that a lot of people are asking is, well, do I have to further, kind of allocate that compensation cap based upon whether I have a weekly payroll or a bi-weekly payroll? Do I have to get down into how much the individual employees are compensated on a weekly basis or a bi-weekly basis, and look at, do I have a $1,923 compensation cap for a weekly payroll? And the answer to that is not right now. So right now it's really regarded as compensation in the aggregate over the covered period, so that compensation cap is just going to apply over your 8-week covered period. And I don't think that there's any further allocation that has to be done to the weekly compensation amount or the bi-weekly compensation amount.
So if you were going to pay a bonus or overtime, that kind of thing, as long as for that one per employee, it doesn't exceed the $15,385 amount in the 8-week window, it would be forgiven.
Yeah, it'll qualify for forgiveness. That's correct. So, from a planning or a strategic standpoint, as we look at how the mass, working on the loan forgiveness application itself, I think that we're going to see that employers are either out of necessity. So in order to get employees back on their payroll registers, they're going to have to offer additional compensation, or from a planning standpoint, in order to maximize the amount of loan forgiveness, because as we look at how the maximum loan amount was computed, really what you received in the form of the maximum loan amount was 10 weeks worth of payroll. So in order to maximize the amount of loan forgiveness, you would want to essentially spend 10 weeks worth of payroll over your 8-week covered period. So you from a business planning standpoint might entertain the idea of doing a bonus, either to get your employees back on the payroll register or to maximize that loan forgiveness, or you might do a hazard pay payment, again, to have some additional compensation there that would qualify for forgiveness. And we think that both of those are allowed. In fact, the IFRs that were released on May the 22nd, I think further stipulate that hazard pay, bonuses, etc., are, they're going to qualify for forgiveness. Now, it's a little bit different for our owners. For our employee owners, that's going to be limited to the prorated amount of compensation from 2019. So I think what we're seeing there is the SBA didn't want to see owners take a significant portion of the loan themselves or to artificially inflate their own payroll. So they're going to limit the amount of owner compensation back to what it was in 2019, to say that that's your baseline that's going to qualify for forgiveness.
Okay. I think we've mainly covered most of the questions that rolled up under that. So we're going to move to rent and lease payments. Some questions that came through are about leases like your copier lease or a vehicle lease. Can you guys touch on what things that roll up under that are considered that you could apply for forgiveness on?
Yeah, so on the leases, it's real and personal property. So the copiers, any vehicle leases, that all qualifies. The caveat is the lease had to be in place on February 15th of 2020, and you had to have an actual lease. So what we've seen a few times with people is they have a self-rental on the real estate side, meaning they own the real estate in a different entity and they operated a business out of a separate entity, and they may or may not have had a written lease in place. But you are going to have to supply the lease with the forgiveness application. So those leases needed to have been in place prior to February 15th. But the real and personal property.
Right. So really in personal property, I think it's important to note, from a documentation standpoint, that is one of the items that's going to be supplied with the loan forgiveness application. So you're going to have to provide a copy of the lease agreement, and then to substantiate the expenses, you're also going to have to provide copies of receipts or canceled checks that demonstrate the amount of payments that were made over the covered period. So we're going to see, I think, that as businesses are going to have to accumulate those lease documents, that's going to dictate what's going to qualify ultimately as non-payroll related to rent or lease. And I guess, supplementary to that, we're going to have some guardrails here. I think there's certainly a lot of questions coming forth with regard to non-payroll related costs, whether it be rent, lease payments, interest payments, what qualifies as utilities. We've seen questions with regard to, is it on the utility side, is it just telephone, is it just electricity? What is truly defined as a utility payment? Does trash count? Does recycling count? We're going to have some guardrails there. I don't think that we're going to see a lot of the non-payroll costs become excessive. Just the way that the loan forgiveness application is going to work mathematically, those non-payroll costs are going to be limited to 25% of the loan. So we're not going to see those become very excessive. I think that businesses could go through a fairly significant exercise trying to accumulate records related to a lot of non-payroll costs that might fit into these different subcategories of rent or lease payments or utility payments. But it's going to, I guess at the end of the day, kind of be an unnecessary exercise to try to boost those non-payroll costs, at least the way that the loan forgiveness application works right now.
Okay, so thank you. What I understand you to say is that you can only, 75% of what you received had to go to payroll in order to be forgiven. So the 25% that's left is what can apply for forgiveness toward all the other things. So you're saying you could spend a lot of time looking at every other little thing that you could get for that other 25%, but it's not going to be able to exceed 25%, so it might not be worth digging down into every little thing. Because once you really look at what you have left, then your rent and utilities might cover it, might cover the 25% that's left.
Yeah, exactly. So we could, go through the exercise of saying, on our utility payments, that's going to be electricity, heat, gas, water, sewer, etc. The more traditional utility expenses. And then we could, add on to those trash, recycling costs. And I don't know that it's going to be advantageous to go and track down copies of those invoices, because you're going to have to demonstrate that you had those expenses back in February of 2020. And you're going to have to track down copies of the receipts or canceled checks throughout the covered period. And at the end of the day, we still kind of got this guideline to say that the non-payroll costs can't exceed more than 25% of the loan. So I don't know that it's going to make sense to dive down and try to track down each and every one of these costs, or try to accumulate a whole bunch of additional costs, or try to identify stuff that might fit into these categories, but is a little bit into the gray area once we've already reached our 25% threshold for non-payroll.
Thank you. One question that did come in is that I want to address is, are the payroll figures we submit for forgiveness off of the gross pay?
Yeah, good question. So, one of the initial interim final regulations that was issued shortly after the start of the program said that it would be, it held true to the language that's in the CARES Act itself, that said that withholdings and so tax withholdings, as well as any type of employer taxes that are owed, are going to be excluded from your payroll costs. And that was in one of those initial interim final rules. Subsequent to that, we, through the FAQ, and I think it was FAQ number 16 that was issued by the SBA, identified to say that while the act said that it would be net pay, they believed that really the intent was for gross pay to qualify. So we saw that in the frequently asked questions that were issued a few weeks after that interim final rule. So then we're in a situation where we've got an interim final rule that says it's based on net pay, that's in the Federal Register, and we've got the FAQ, which from a hierarchy standpoint of authority would be weaker than what's in the actual Federal Register, and that says that it's gross pay. That's all subsequently been corrected through the issuance of the interim final rules that were issued on May the 22nd. It's going to be based on gross pay or gross compensation. Now, the employer side of payroll taxes, so the employer obligations, those are not going to qualify for forgiveness, but it is going to be gross compensation as opposed to what we'd say net compensation is.
Okay. I think that makes sense. So hopefully, so the employer part of the payroll tax is not forgivable, but the amount forgivable is the gross pay for that employee.
Yeah, correct. So that's going to include your payroll withholdings as well as any of the payroll taxes that are borne by the employee itself or themselves are going to qualify for forgiveness.
We've been talking about 75% for salaries, 25% for utilities and rent. The question that just came through is you can do more than 75% towards salary, right? It can be 100% salary.
Correct.
Yeah. So to clear up the 75-25, the 75 is not a cliff, meaning if you don't get the 75% for payroll, you get nothing. The 25% is not of the loan amount, it's of the amount eligible for forgiveness. So whatever you spend on the payroll piece, you can have 25% of the loan, the forgiveness amount eligible through non-payroll costs. So when you do the math, whatever you've spent on payroll, a third of that can be costs that are not payroll. But you could spend 100% on payroll, which if this gets extended to 16 or 20 weeks, more than likely you'll have 100% in payroll and you'll have less documentation that you have to submit for the forgiveness.
Okay, so back to, thank you, some of the overarching questions that BKD that you guys have been getting asked. One is, I was unable to pay my employees for a period of time prior to receipt of the loan. Can I pay them the back pay they are owed?
Yeah, and I think that, and we've gotten this question several times, businesses found themselves in a position where they were experiencing a cash crunch. The PPP loan afforded them the liquidity that they needed and provided them the ability to pay some of that back pay that was due to their employees, that had been working. And I would say that that is going to qualify for forgiveness if it is paid during the covered period. So if you use some of the loan to pay some of that back pay that was due but had remained unpaid, that is going to be qualified expense as payroll costs over your covered period.
Can you talk about the full-time employee count? Because the other incentive was that you maintain your head count. So can you talk a little bit about those changes or nuances with that?
Yeah, so they defined full-time equivalent as anybody who works 40 hours or more. So to count as one, they have to be 40 hours or more. Anybody less than that, you divide by 40 for the week and you get a percentage of full-time equivalent. They're rounding to the 10th and they're not rounding up. It's normal rounding. So they came out and they said to round, and people thought 8.2 rounds up to 0.9. And they said use normal rounding principles there. But on the full-time equivalent, so you can spend however much money you want of the loan balance on qualified costs. The amount that will be forgiven is in part based on maintaining your full-time equivalents. So you have options on your look back period, your target period. You can use February 15th through June 30th of 2019 and get your full-time equivalent count from that period. And that's what you need to maintain during your 8-week covered period. Or you can use January and February of 2020. If you are seasonal, a seasonal employer, you can use any consecutive 12-week period between May 1st and September 15th. So you take that number, whatever your full-time equivalent is during your look back period or your target period, and that's what you have to maintain during your 8-week covered period. Now the covered period gets looked at for the full 8 weeks. So if you had somebody who worked 60 hours 1 week, then that's 60 hours for the full 8-week period. It's not on a week by week basis that you're counting full-time equivalents. You're counting it for the full 8-week period. They also gave us some exceptions out where we don't get dinged, I guess, for not having a full-time equivalent. But if you had furloughed somebody and they went on unemployment and you gave them a written offer to come back and they declined, then that person will not count against you. Now they did say, and Nathan will correct me if I'm wrong here in a second, but they did say that you have to turn that into the state unemployment offices for those folks. So they're probably going to go back and claw back the unemployment that those folks have been paid. If somebody voluntarily resigns and you don't fill that person's position, they will not count against you. If you terminate for cause and don't fill that position back up, they won't count against you. And then if somebody comes in and voluntarily wants to reduce their hours, they won't harm you in the full-time equivalent comparison.
Yeah, and that's exactly right, Corey. In order to, it really comes down to those employees that businesses were not able to get back on the employment registers. There's going to be some steps that have to be taken by the business in order to not be harmed by that employee. And what they really need to do on the business side is they need to document that they made a written offer to rehire that employee, that the offer was for equivalent hours, equivalent wages, as compared to the last pay period prior to the separation or hours reduction. So going back to whenever they were full-time prior to maybe not a termination, but a furlough. They need to maintain records to say that the offer was rejected by the employee, and that they subsequently, within 30 days of receipt of that offer being rejected, contacted the state unemployment office and notified them that a written offer had been made to that employee and that they had rejected it. So there are some steps there that need to be taken by the business in order for them to not be harmed on your full-time equivalent count for employees who refuse to return back to work.
Okay.
Somebody asked the question here in the chat, will they be more lenient later on? Are we expecting leniency in the full-time equivalents? What they did give us up to this point is that anybody that works less than 40, we can just qualify or classify all of them as a half of an employee and not have to go through all of the math. So if you have, say you have employees that work 15 hours a week, we can get those to count as a half, but it will hurt you for, let's say somebody works 32 hours a week, they're also going to be counted as a half of an employee as well.
Yeah, and kind of along that same vein or point of conversation, there's a lot of decisions that can be made by the business in their forgiveness application. So, we've got the decision of the election of the alternative payroll covered period versus the traditional covered period. We've got a decision to make with regard to our look back periods. Are we going to look back to 2019, or are we going to use, the first 2 months of 2020? Then we've got a decision to make with regard to the simplified method to compute full-time equivalent employees, or go through the math to the 10th on whether or not they are a full-time equivalent, counting as one, or what percentage of a full-time equivalent those employees are going to be counted as. So with each one of those decisions, I kind of look at it like we have opportunities there, and it's going to be a real facts and circumstances argument or test. It's going to be not just universal across the board. It's going to come down to, are the majority of employees salaried, or are they hourly employees? That's going to dictate some of those decisions. And I think it's going to be advantageous, at least the way that things are presently, for businesses to work through each one of those variables in their computation in order to achieve the maximum amount of forgiveness. So maybe not just to take the simplest method and run with it, because if they were to evaluate some of these other opportunities out there, I think that they could fundamentally qualify for additional loan forgiveness. So it's going to be really important to kind of run each one of those scenarios through to determine how much loan forgiveness they could qualify for based on which decisions they made.
So the for full-time equivalent, there is a calculation for your part-time employees on how to figure out how many of them qualify as a full-time equivalent. Did you just say the calculation, or could you repeat it? Or there's a couple different ways to look at it.
Yeah, there's going to be two different ways to look at that. There's a simplified method, which says that any employee who's working less than 40 hours a week is going to count as half or 0.5 FTE. And then there is a computation where you're going to go and take a look at their hours, and on a weekly basis, divide that by 40, and then factor that out to the 10th to determine which or what percent of a FTE that employee represents. So it is based upon a 40-hour work week, which is kind of a nuance here. That in corporate America, I think, is probably what we identify as a full-time equivalent employee. But, if we go back to definitions that are out there from the IRS that really relate back to the Affordable Care Act, in the Affordable Care Act, we were typically using a 30-hour-a-week threshold to determine the FTE. So this is a little bit different, kind of defaulting back to what historically we think of as a true full-time employee is going to be set at that 40-hour-a-week threshold.
Okay, thank you. So there seem to be some decisions that the borrower will have to make, and that you just went through some of those and explained why it's a little bit complicated, all the decisions going into the application process. So that's something that as we each sit down to fill it out, we need to be looking at all the different ways to show the data to figure out which way is going to help us the most with forgiveness. Are there any others you would want to mention there?
I think one common question that we get when you filled out the application, you had to put total number of employees on that application, and that was that had more to do with affiliated groups and large companies with more than 500 employees. And at that point, it was a count, an employee count. How many did you have? So we've seen nothing up to this point that says the employee number that you put on your application will have any bearing on your forgiveness. You're going to have to provide the support for the period that you choose as your target period, and then you'll provide the support from an hours and pay standpoint during the covered period. So if for whatever reason on your application, you said you had 50 employees, going by 40 hours makes a full-time equivalent, you only have 32, then with the 40-hour definition, that will be your target. The 50 that you put on your application will have no bearing.
Okay. So on the forgiveness application, it references an idle advance amount. Can you guys talk about that?
Yeah, the EIDL program is a sore subject, sensitive subject to a lot of people, but with the EIDL, originally you could get a $10,000 advance by submitting an application and you would get funded within 3 days. If anybody went through that process, you know you did not get funded in 3 days, and depending on the employees that you have, they changed that to $1,000 per employee, so you might have gotten less than $10,000. But the thing that they kept was whatever your advance amount was, or your grant through the EIDL program, that amount will come off of the amount that's forgiven through the PPP program. So if you qualify, let's say you got a $100,000 loan in the PPP and you qualify for full forgiveness, you will get forgiven for $90,000. They're going to not forgive whatever advance you got through the EIDL or EIDL program.
Okay. So we have a couple specific questions regarding paying partners or executives that aren't owners. Can you guys address that a little bit of how that would figure into the forgiveness?
So for our executives, they're going to be limited on the amount of compensation. That compensation cap is still going to apply. So 15,385 over a covered period is going to be the compensation cap for our executive, non-owner, just strict employees. And then with regard to our partners, typically in a partnership, the partner should not be receiving W-2 wages. Rather, they're going to be paid through guaranteed payment. And the maximum amount of loan should have been based upon, I think it's box 14A off of their K1. So their earnings from self-employment, and the amount that's going to qualify for forgiveness for those partners in the partnership is going to be based upon their 2019 earnings from self-employment. So aligned with the computation for the maximum amount of the loan, as opposed to what their, let's say, distributions would be or what their guaranteed payments would be.
And then I know we have a lot of self-employed people asking questions about sole proprietors and that type of thing. So
Sure.
could we touch on the different requirements for them when it comes to filling out the application?
Yeah, so for our self-employed sole proprietors, there's some, I guess, kind of odd nuances in how both the computation for the maximum amount of the loan worked, as well as how forgiveness is going to work. So from a maximum amount of loan standpoint, and whenever we're talking about sole proprietors, we're typically going to say that those individuals are filing an individual income tax return, and any of the business income is going to be reported on a Schedule C that is incorporated into their 1040. And in order to compute the maximum amount of loan, it would have been based upon their 2019 Schedule C from their 1040. And it would have been capped at $100,000. And if they were under that cap of $100,000 of net income or profit derived from or shown on the Schedule C, then you would have divided that amount by 12 and then multiplied it by a factor of 2.5 to arrive at what the maximum amount of loan was that they could receive. And they, if we say the loan max there was $100,000 profit, or based on $100,000 of profit, the maximum amount of loan that they could have received would have been $20,833. Now, on the forgiveness piece, it works a little bit different than it does for our S corps, partnerships, other business forms. In order to have any non-payroll costs qualify for forgiveness, on your 2019 Schedule C, you would have to have deductions on those appropriate lines on the Schedule C. So for rent to qualify, you would have had to show a rent deduction for back in 2019. For interest, again, it would have to be reported on your 2019 Schedule C, a line item for interest expense. So you've got to have those expenses back in the prior year in order to qualify or claim those non-payroll costs in the current year. Kind of another, I guess, odd thing is on your, so we've talked about on a Schedule C how to compute the maximum amount of loan, and it to be based on the profitability of the Schedule C divided by 12 times 2.5. But then in order to determine the amount of owner's compensation replacement, that computation is going to be different. So you're going to say that it is the 2019 net income on the Schedule C, and then it's going to be multiplied by 8 and divided by 52. So that's going to arrive at that max of 15,385 again. So we could end up in a situation where if on the Schedule C, the applicant doesn't have any other expenses in 2019 for rent, interest, or utilities, but they had profit of $100,000 or above on the Schedule C, they could have received $20,833 in max loan, and then only have owner compensation replacement that's eligible for forgiveness of $15,385, and they're going to have then part of that max loan that's not going to be forgiven.
Okay. So simple. Do you guys, we just have a few minutes left, so is there anything we haven't covered that you would want to make sure to talk about? Or just start, you know, any advice you have on starting the application process or the right way to act on it right now?
Yeah, I think one thing we didn't touch on, I think we talked about it 8 weeks ago when we were here, but your covered period, you get to pick when it starts, but for that last payroll period, you don't have to run a special payroll on the last day of your 8 weeks. They're going to allow you to count the money or the checks that were written to everybody for the time that was in that last 8 weeks, even though you're paying it outside of the 8 weeks, as long as it's paid during the normal payroll processing of your company. For the non-payroll costs, they've come out and said that they will prorate those back to the 8-week period. So we're not going to get extra months on the front end and back end, depending on when we cut the checks. It's going to be prorated to wherever your 8-week period lands.
Okay, thank you. That's very helpful. So it could, your last payroll could fall outside of the 8 week, but as long as it's covering time that was within that 8 weeks. The amount forgiven will only be for the time that was done in those 8 weeks, not if there's a week after.
Yeah, the confusion was in the bill, it says paid and incurred. So how do you incur payroll and pay it during that last segment of your 8 weeks? And for your last payroll period, it can be incurred during the 8-week period and then paid after the 8-week period.
Okay. Thank you. That was helpful. Any other insights you would want to share or based on some of the questions that have come in today?
So we've got the one thing we haven't talked about is there is a cure if you have fallen outside of the full-time equivalent count during the 8-week period and may not be eligible for full forgiveness. And Nathan touched on this earlier when he talked about when banks would start accepting applications, but the cure in the CARES Act bill was not very clear. So the way it will work is you have to look at your full-time equivalents for the pay period that included February 15th. And then you look at your full-time equivalents from February 15th to April 26th. I believe it's 26th or 27th. I think it's the 26th. And if you've had a reduction from February 15th through the average of February 15th through April 26th, then you qualify for the cure. To cure, you have to have on June 30th the same number of full-time equivalents that you had on February 15th. If you get back to 100% of what you had on February 15th, you now qualify for 100% forgiveness. You still have to work through a salary reduction where they may reduce the amount that's forgivable. That can also be cured by June 30th. But it's important to remember that if during your 8-week period you haven't fully staffed back up, or you've been closed, or you can't get people to come back to work at no fault of your own, then as long as you've had an employee or any full-time equivalent reduction during the February 15th to April 26th period, you can cure that by June 3rd and still be okay.
Yeah, and that's, I think, a big question there is well, how far in advance of that June 30th date do I have to increase my FTEs or increase my salaries? And then how long do I have to maintain those salary or FTE levels? And unfortunately, right now, there's really no guidance there, because we're looking at that one date, June 30th, and what the pay was on that date, and what our FTE number was on that date, so that specific point in time. That's going to, I think, provide some additional planning opportunity there too. If you run through the computation, say I have had an FTE reduction between February and April the 26th, I think that you can then go through that exercise of saying, okay, well, if I've got these number of employees and they typically work 35 hours a week, then could I make some elections on my how I count FTEs, either as the simplified method or the traditional method, and effectively work into a position where you have cured that by boosting their hours during that pay period that includes that June 30th pay date. So there's, I think from my standpoint, the word of advice here is to start walking through the computation and the different elections that a business could make right now in order to provide yourself enough time to make some of those business decisions if you start approaching the end of your covered period and we don't have any additional guidance and there will have been no legislative changes. Then I think you're going to, as a business owner, be in a position where you're going to want to make some decisions with regard to, do I maybe boost or provide some bonus or hazard pay here in the last couple of weeks of my covered period, or does it make sense to increase pay or increase hours as it relates back to that June 30th pay period? But it's going to be important to kind of know where you stand right now as you start to move through towards the end of your covered period in order to afford yourself enough time to make those changes.
Okay, thank you. We did two things I just want to hit on. There's been questions about commission only and how you factor those people in. So can you touch on that quickly?
Yeah, so if you have somebody that's commission only, they were included in your loan amount up front. So if you're continuing to pay them, they're going to count during this period. So part of the program was you couldn't reduce anybody's pay by more than 25%. So depending on what commissions they've made for you during, or that they've made for themselves during the 8-week period, you are going to have to look back at the period that you're looking at for your full-time equivalents. So that's not true. You're looking back at first quarter of 2020 on the pay. So what did they earn in the first quarter of 2020? And it breaks it down in the forgiveness application to an hourly rate and the steps you have to walk through. And then you cannot reduce their pay by more than 25% as it relates to an hourly wage for those folks.
Okay. And just a clarification, if you don't have your FTE cured by June 30th, you can impact that by increasing your payroll with a hazard pay or something for the team that you still have on staff. Is that right? To make sure you're using all your forgivable amount.
Yeah, I think the takeaway there is you have options. So if you're in that situation, you need to consult with whoever it is that you consult with. We're obviously happy to have those discussions as well. But if you've either reduced pay and you need hazard bonuses or hero pay to get back to the levels you need to be at, or you've reduced your staff to a level that the FTEs don't match and you're not going to get 100% forgiveness, then you can cure that in multiple ways, either through bonuses or through the cure on June 30th if you qualify. And you can also cure the pay by June 30th. To Nathan's point, it's a 1-day period that we're looking at right now. So there may be future guidance coming on that, whether it's the pay period that involves June 30th or a different set of rules altogether. But if we get an extended period of time to spend this money, now we're going to go out through June 30th, and what does that look like? So it's still a very fluid situation, but there are options available if you're trying to plan to maintain 100% forgiveness.
Well, thank you guys so much. I know we've thrown a lot at you. We've gone really fast trying to cover as much content as possible. But you guys are so gracious and knowledgeable, and we really, really appreciate your time, Nathan and Corey. And we have recorded this. It will live on our biz417.com/PPP. So it should be up later this afternoon if you need to rewatch it for clarification on certain items or want to share it with others. And then I would just give a little plug for our Biz 417 B School coming up on June 11th. It's a virtual B School event, and we're going to be talking with some business leaders who had to make huge pivots during all of this. We're going to talk about the decisions they made and then how they're faring now. So when we first talked to them for this article, they were in the throes of it, and now that they've had a few weeks to adjust to their new normal, we're going to hear how they're faring now. So that is on June 11th, and you can purchase your tickets at biz417.com/bschool. But I just want to say thank you again to BKD CPAs and Advisors for helping us today. You guys are such a wealth of knowledge, and I so appreciate it. I know you're working around the clock, so for you to take an hour and let us just throw every question possible at you is very much appreciated. So thank you to our audience for attending today. I hope that you found this helpful and that you can go back and rewatch it to get clarification on some of the points. It's a lot of information, but thank you all so much. And I really, truly wish you the very best for your business as you continue to navigate this. So thanks, guys.
Thank you.
Thank you.